something. It was Boys of Oklahoma, right? And a group called Cross Canadian Ragweed, and they're a red dirt music group, but they brought in a bunch of their buddies and sold out the stadium. There was 180,000 people from over 4 days that came to these concerts. Crazy, right? It's nuts, and so it was really kind of a big deal here in Oklahoma. So Cross Canadian Ragweed. It's a group coming out in about the 90s, but if you ever have a chance, you ought to look them up. They're pretty good. Um, anyway, let's talk about what we're here to talk about. We have a competition going on, right, for a new computer. If you guys are not, it's not brand new, but it's a good Mac computer. So it's got about, I think the one that we're giving, my wife said had about 2 years service on it, so it's about 2 years old. But it's brand new. It's we cleared it and it's good. So it's a Mac computer. I've got about four of them in my office, and these are. They're our go-to. So if you ever have a chance to get to Seminole, Oklahoma, you're welcome to come here and work out the office with us. And we got Mac computers. That's what we use over here. And so anyway, we're going to be giving that out, and I'll be mailing it to the person that has the biggest or the most sales um, over the course of a month. So I think we're going to end it on May the 15th in the advanced market system, right? The AOM. So we want you to be doing the debt-free life program and really embrace it or Fortis, one of the AOM system. But whoever can produce the highest AP over the course of the month is going to be getting the MacBook and or Mac computer. And so that's going to be a neat giveaway. Um, that's coming up. Anything else? Tomorrow's training and Wednesdays are always my favorite trainings of the week. You guys know that AOM training with Scott, and so Scott's not able to join us this morning. I think he had doctor appointment stuff going on. I believe what I heard, but um, anyway, he does his training on Wednesdays at noon. So the our training Wednesday, they're pretty long, right? So our trainings we do Monday leadership trainings on our kind of on our own. Tuesday we do the carrier trainings, what we started doing. Today we're going to be doing Americo. Wednesday at 9, we're going to keep the health training going. So tomorrow at 9, what we're going to be doing is we will be going over how we're putting the leads, your 1,000 leads into your CRM. And it's not Rick and those guys. It's just me, you, and Jane, right? So we're going to be going how we're going to start working those. We'll start working those tomorrow. At 9 o'clock, we're actually going to have them loaded into your CRMs if you have the leads. And we're going to start doing those calling tomorrow. We'll do that at 9. Tomorrow at noon, we have the AMM training and then the advanced market training at 3 o'clock in the afternoon. So tomorrow's kind of a busy day. Thursday, um, we have, and I don't know, no, yeah, Misha is going to be training Thursdays. We're excited about that and get Misha training on Thursday. And then Friday, we have our typical Friday training, and I'm not going to announce yet what it's going to be, but it'll be a good one for sure. So kind of squared up, cleaned up a little bit of stuff. Now, let's talk about Americo. Um, I actually love this company. I wrote with them a lot when I was at the other IMO. As a matter of fact, um, they give you back then I think it was the 8% bonus, but now I'm pretty sure it's a 10% bonus if you write over so much. So I'm going to share my screen, and I'm wearing my Americo shirt today. So I wore it. I wanted to wear it just to represent. When I went on the cruise, they'd actually sent me a shirt and some beach towels, and so that was kind of cool. Um, let's see if I can clear it. Patient with me. Okay, I gotta move this over where I find my Americo. Can you guys see my screen?
Yes,
Okay.
your def
All right.
your your messy desktop screen.
Yeah, I know. It's crazy. Okay, so Sorry about that. Let's see. It's okay. So the agent tools. This is the portal that you'll go to when you get Americo. All right, and it's got the agent portals, agent tools here. We'll go into the agent tools, and we're just going to talk about. Um, let's see. Let's go to the portal for a minute. And let's see what this looks like. Type in my stuff here.
Go to the bottom right there, Darren, on the very bottom on the left.
You
That
talking to me?
agent tools. Yeah, right there.
Yeah.
Down. A little
Right
lower.
here.
To the right. Where it says agent tools right there.
Yeah. Yeah.
That's what you click on.
Right. What I'm looking for is the on here. I'm going to see if it has the yeah here the you first or the first.
It came in an email this morning.
So what is it? It is a they have a I was going to see. Hey, okay, what their bonus is now. It used to be at 10%. You get 10%, and I can't remember. I think it's 40,000. That's what it used to be. So I was going to see if
It's 50,000, Darren.
did they raise it?
If
Okay,
once
back
you reach 50,000 of qualifying live production
here
during
it
the
is.
qualification period, you have
Okay, here
eight.
it is. Yeah. So earn a 10% bonus, cash bonus on life and on life business, right? So when you write $50,000 over a 6 month period, you're going to get a 10% bonus. So that would be, oh, here it is. So get a $5,000 bonus. So you get that at in July and then again in December, right? So that's how they do it. And you got to maintain good persistency, but that should be doable. Um, so
That
anyway,
one says through May 31st. Is there a new one that goes through July or something?
and this one is that what this one says, May 31st? So
December 1st,
yep,
2024 to May
yep,
31st.
yep, and they'll start another one in June.
Oh,
There's
And then
Darren, there's 46 days left.
okay. So this one, the new one will start in June. So if you really want to push for it, start writing a lot, and by June you can do that. And June through December, have your 50,000 submitted, and then they'll give you a $5,000 bonus. So I always like that one because I got my bonuses right at Christmas time, about 2 weeks before Christmas, and I always got about a $5,000 bonus on those. So it was nice to get those bonuses from Americo. That's one reason I like them so much. But I'm going to tell you the other reason I like them is if I can figure out how to get back out of this, X out. Everything's covered up on my screen. Here it is. Okay. So we're going to go down here to tools. And we will type in state, what's the Oklahoma. And this is how we type up an application with them, right? It's real simple, probably the easiest app that there is out there. And we could put in a date here. Let's say birthday. Let's go 56. Okay. Now here's the different, if you do 56, we're just going to go each one of, over different applications we got here. The first one is Advantage Whole Life. We don't just forget this one, ignore it. It's a fully underwritten, and we got better carriers. We won't use it. We will never use this. Eagle, that's your final expense product. I like this new product. It's different. They changed it up over the years. Used to, I wrote a lot of business through Americo, but the reality was they weren't the cheapest. They were actually one of the higher ones. And the reason why is because they forced you to throw in an accidental death on top of it, and which made the rate go up about $7 or $8 a policy. And it was easy for people to go back and find something cheaper, right? They would say you don't need the accidental death, and all this, and they would so it was hurting them. So they've changed that. So now they've taken away that where you can just add it, but it's not forced sewed. And now their prices are actually cheaper than probably 90% of the carriers that we have. So I like that. The other one is the term policy. They've got good term products. Their underwriting is better than the term carriers that we typically use, but the rates are going to be a little higher. And we're going to go over there and do some comparisons, okay? The annuities, that we're probably not going to write many annuities through these guys. That's going to be a Scott decision. But we've got carriers that we like to use with annuities, and it's not going to be the Americo more than likely. And then we got an instant decision IUL, and we're going to show, so we're going to show these three today, and I'm going to show you why I like these for instant decision companies, right? But let's look at the final expense. We're going to do one of those first. Let me see if I can move this out of the way. Run it. And this is how you run your illustrations or your quotes, okay? I wonder if I can make it smaller. It's your there we go. Okay. So state, we got the birthday on here, the age. We're going to go male, non-smoker, premium. We're going to go 10,000. I don't know why this isn't kind of backwards for me. The premium and it's 10,000. You would think face amount would be 10,000, but you got to highlight this one to do that. If I highlight that, it shows you the dollar amount, but which would be premiums. It's backwards to me, so just be aware of that. $10,000. If we're gonna do, let's just run this right. I sold one of these this week and it was 25,000. She wanted one for her and one for her husband, and this is one we did. So we did 25,000. Bank draft, accidental death. I'm just gonna put yes on there so you can see what the rates are. And then they get children's, grandchildren, term riders. If they want to get those, you can just do it right there. But the rates on it is already gave me the quote, right? So 25,000 is only 87.71. Anybody, if y'all want to run me a quote with one of your other carriers, maybe somebody go to Insurance Toolkit or go and just give me some quotes from other ones at 25,000 and kind of give me a comparison here, okay?
I got
If
it.
you're coupling that with,
SBLI. If you
yeah.
want SBLI, $25,127.
Dang. Okay, so you see the difference. So their rates are going to be pretty good, guys, and really one of the better rate companies we're going to have. But so I like that. 94, if you want to throw in accidental, that'd be 50,000 total coverage, 25 whole life, 25 accidental for a total of 50,000 in coverage, 94.41. Now, then you simply, if you want to start the e-app, you go here. And I'm going to show you why I like Americo. You guys know my eyes aren't the best. So I went last night to the eye doctor, and hey, he gave me a good report. He said everything's going well, but I do still got to go back and get shots in my eyes. So I got to go back in 2 weeks to get a shot in my eye, and then but it's to maintain it, and so that's a good thing. It's not getting worse. It's actually getting a little bit better. So, but this is the reason I like America. Look at how it is, right? Very large print. It makes it very easy to fill out. And the whole application is like this. So when I was speaking at the conference in Vegas and the Americo reps and all these other ones were in the building, I brought this to their attention. I said, like, hey, Prosperity, you guys are dropping the ball. I said, I wrote about $70,000 worth of Americo the last few months, and this is why. This is why, because I can actually see the application, and they laughed about it, but it's actually there was a lot of truth behind it, and so you can kind of see how that goes, right? So we're not going to write a whole application. We can start into one. So this one just says we do remote signing for the most part. If you're doing in-home, you would just mark here, but we're doing remote signings. Is the payer intended to use an online? This is real important. Does the payer intend to use an online city only bank, including but not limited to Chime, MetaBank, and Cash App? So if you put yes on there, you're not. It's not going to pay the premium. If we put yes, I think it says America does not accept these banks, right? So obviously you wouldn't put yes. You just say if you're having to use a Chime account or one of the meta banks like that, you're not going to use Americo because they're not going to accept it, right? Go continue. You just fill in the birth date, remote signing by phone, in person, all this. Let's see, we got birth date. It's going to make me do it here, isn't it? T 60. Name of the insured, height, the weight. They're going to need a social, confirm the social, the place of birth, and they just want the state. And will the insured be the policy owner? Almost always put yes. Rarely would that be no there. Now, when you guys, little education here, when would I maybe put a no on policy owner? Can somebody tell me an example?
When we're using a surrogate,
Not really in this sense,
not in this sense.
but not in this sense. So when I would is
Well, if
if
you,
yeah, go ahead.
I was just gonna say,
Tell
if you
me.
have a child getting a policy on their parent, then and they're gonna
All
pay
right.
for it, that would be an instance, or
Yeah.
so just somebody else who's paying for somebody else's the
And not
insurance on
always
someone
the
else.
owner, right? But that would be the payer. You're right, Jody, in the sense that they're the payer because you're going to have three people going to sign: the policy owner, policy payer, and the policy insured, right? Now there's three different ones. Usually, almost always, the owner is going to be the insured. But I'm going to give you an example when that wouldn't be the case. Um, you got somebody that's drawing that's on Social Security, and the Social Security Department tells them that you cannot have life insurance. And you're going to hear people say this, oh, you're not allowed to have life insurance because the cash value of your life insurance will affect your getting Social Security. And those people don't know any better because they don't know life insurance, right? So they go to a Social Security office and they say, "Yeah, you got to list everything you got. Do you have life insurance?" And if they say yes, a lot of times they're going to tell them that you can't have that. And I've had clients call me and they say, Darren, they're telling me I can't have my life insurance. I'm going to have to let it go. I'm like, they're not telling you the truth. They don't know the truth. The fact is, if you're worried about that, that the reality is the cash value is it takes years and years to build up. But if you are worried about it, we can fix that. You would just simply make the child or the beneficiary the owner, the policy owner, okay? And so if they're worried about that, say that's okay, no big deal. We're going to make your beneficiary the owner of the policy. The cash value is then associated with the owner of it, meaning the beneficiary, and then you don't have to worry about that. So if that ever comes up, that's when you would make the beneficiary policy owner. Does that make sense? Okay. Mailing address, typically you would just change it if it's here. They're going to ask, have you then there lived there less than 6 years? Make sure you're looking at the way they word that. All right. Have the insured lived at their current address for less than 6 years? So if they lived there more than 6 years, the answer is no. Okay. If it's been more than 6 years, no big deal. They're going to ask you, what was the previous zip code? And just ask them that. Okay. Um, Email address, important to get it right. We're going to, right here, most older people want a policy delivered. If you're doing a term policy and they're younger, a lot of times they want the electronic delivery. But most people doing final expense, they want a hand policy mailed to them. So make sure you mark that. If you don't mark that, it automatically goes here, and then your clients are going to be calling you saying, "I never got that policy." Well, it's because you didn't mark it here. So make sure you mark it there, okay? And then this is important to always put a cell phone number, because the cell phone number is how they're going to get their text to sign. And I like the text to sign, guys. It's my favorite. You can do an email to sign as well, but I like doing text to sign. And later, but put in their cell phone number. And that's basically, I'm not going to go through the whole application because there's a lot more I want to talk on, but that was a final expense plan right there. If I want to do a Eagle series, okay. Okay, so we're going to get out, let's see, go back here. Agent tools. Go back. Now we're going to talk about the term products, how to do them, when to write a term product. Let's just say, let's go with, you want to go with a 40-year-old male, okay? We're going to go down here and click instant decision term. And while I'm doing this, will one of you go into your ladder and look up a quote on a 40-year-old male on that one? And I'll tell you why in a minute. So we're going to go male, 40-year-old. We're just going to stick, be consistent, say no tobacco. Now let's look at the products here, okay? So we're going to have options, and you guys might take note on this, all right? Cashback option 100. What does that mean? What that means, it's the same as the return of premium with Kansas City Life. What that means is that the person will get 100% of their money at the end of the term. I used to sell a lot of these. Matter of fact, this is what I sold the most of when I'm doing mortgage protection back in the day. Because I would simply say you can get a regular term, but we can invest a little bit more money and turn it into an investment strategy. And then at the end of the term, you're going to get all your money. So it's basically free insurance. What you're doing is you're just investing and going to get all your money back at the end of it. And that's just called a cashback option 100. And we'll run those quotes. And then you got a cashback option 50. It's going to be a little bit cheaper than the 100, but they're going to get half their money back. So if it's really about budget, but they do want to get some of their money back, you can do a CBO 50. Then the term 125. What that means is you get your full amount that you're taking out. So if you have a $200,000 home and you're doing mortgage protection, you would get 200,000 plus 25% of that would be accidental. So you would get, what's 25% of 200,000? It would be 50,000. So the policy would be 200,000 term, 50,000 accidental. A term 100. They don't throw in the accidental on that one. It's just going to be $200,000. Now, it's going to be cheaper than the term 125. So a lot of people automatically go to term 100, but they're going to cut your commissions by about 20%. So I never even offered it unless they were really fighting for about pricing, and then we might go there. But here's how I would present this one. I wouldn't even give them a quote on term 100. I would just simply go, okay, we're going to look at a term 125, and what that means is you're going to get the full 200,000. But if you did die from a car wreck, as we already talked about in the presentation, to get insurance, they're going to give you an extra $50,000. Okay, so let's run this for 250,000 and just see. Or yeah, we'll do 250,000, and let's just do 200 since we were on that quote. Okay, 200,000. Monthly, and we're going to look at a 30-year, and then we're going to see what these rates are, okay? And we're not going to add any of these riders right now. We're just going to kind of look at it. So 200,000 for a 40-year-old is 104.69. Now, did anybody give me a quote? Fred, did you happen to look it up, or somebody else?
And then
Okay, tell us the difference on 200,000 at a 40-year-old male.
so 200,000 40-year-old male for ladder, you're looking at anywhere from the ranging of 38.90 at a preferred plus to $66.78 to standard.
On a standard. And I'm telling you, the standard ratings are pretty not too hard to get with those guys, okay? Half the price almost. It can be more than half price if they get the preferred, and a lot of people get those preferred ratings. So does it always make sense to go Americo on term? Now on the whole life, the final expense, I'd say write all your final expense Americo if it were me, just because I know what the rates are. I know the underwriting. Another reason I like Americo final expense is every time, and I don't know how I get why, but I'm just telling you, every time I got declined with Aflac, and there was a lot of people gets declined on Aflac. Every time I was getting declined on Aflac, I would go transition to Americo, and I got them approved every time. Now, sometimes they don't give you that. They give you two ratings. They're kind of a preferred and a standard, and you'll get the standard rating. But I was getting it every time. I was getting them accepted with Americo, and the rates they were even on that rating there. They were better than the Aflac. So I started writing them instead of Aflac. This became my go-to company now because I don't even have to worry about a decline. They're almost always going to give you an acceptance unless there's some kind of serious issue going on in their health. All right. But let's look at the term $104.69. So why would I write an Americo term? Because it's a simplified issue and a little bit more lax on the underwriting, whereas the other one's going to kind of be a little bit more scrutinized, right? But if I have a company like Ladder Insurance, I don't mind trying them first if it's about rate shopping and doing what's best for your client. So we did one the other day, and I had Renisha on here, and we were running quotes, and I ran a quote for her with Americo, and I got 450,000 on that one. I'll just do one real quick that on that one there. And I'll do the term 100 because that's the one we said a little bit cheaper. So we'll go here and find the product. Renisha, what was the age of that client again? Can you unmute yourself? We're just going to do a comparison. This female. Is she still on? She might have
Yeah, I'm
left.
still on here.
Okay.
I think you did 50, like around 55, 56,
Okay.
couple nights ago.
Okay. We're going to do 55. And was it male or female?
It was a male.
Okay. No, nicotine. Okay, and on this one we did a term. We just ran the quote on term 100 because it's a little bit cheaper, and than the other one. And we were trying to do price shopping, and it was. And now here's the deal: these guys don't go up to $1 million either, right? If they wanted a lot of insurance, you've got to do ladder. These guys will go up to 450,000. That's their max on term. Okay, so we're going to do a 30-year term. Now on this one, look at the price on that one, 707.09. You did, I don't know, yours wasn't a 50 year. So do well, they're not going to let you do a 30-year. You can't really do because the highest they go is 70, right? So we're going to do a 15-year on this one. So we can do a true comparison. Let's see what that one does. It was that 30 year that was kicking that rate up so high. So on this one, okay, 382. So 450,000, 382 a month for 450,000 on a 15-year term, right? For that gentleman. We ran a quote and on hers, and we got him $1 million. And how much was that million? It was in the $120 range. Now, it might have been a little bit younger than that one. I think we're thinking of two different clients, but I'm just telling you, it was probably about a third of the price of what these were. So Louder made a lot more sense on that one, and she was able to write them policies up. So that's that. Let's get out of here and look at other products. Okay, so on these, so we're going to go term 100, term 125, continuation. Let's talk about what these are, right? If I wrote somebody a $200,000 term and they did that term for 30 years, at the end of the 30 years, and let's say they were 30 years when they bought the home and they did a term policy for 200, so they're paying like $60 a month for that 200,000. Let's say if it's just a number, and they had that for 30 years. At the end of 30 years, when that term runs out, if they do the continuation 10, they're going to be able to keep paying for a whole life policy, and it's going to be 10% of the 200,000. So now they'll have a $20,000 whole life policy, and they're only paying 50 something or 60 a month, whatever they were paying for that term. So that's how that works. That's still a good price and a good way to do that. I still never sell these, and I'm going to show you why in a little bit. Continuation 25. That just means you're going to get 25% of it. It's going to be higher than continuation 10. But a continuation 25 means you get 25%. So what would that be? A $200,000 term, would turn into a $50,000 whole life, and you got a $50,000 whole life after your term runs out. So those are okay, but I'm going to show you why I wouldn't necessarily want to do those. Um, I'm either going to do an IUL or I'm going to do a cashback option 100. If somebody says, Darren, I would like to have insurance at the end of my term. I don't want when my term runs out, I'd like to at least have something in place. I say, yeah, we can do a continuation, but what if we did a cashback option where you're going to get all your money back? So at the end of 30 years or 20 years, whatever you break it down to, you're going to get all your money back. And at that point, we can get that to where you can set it up to where you're going to get 30,000, 40,000, 50,000, depending on how much you pay in. But at that point, you can get all your money back. Now, if I had $40,000 at the end of my term, do I need a whole life policy? Not really, right? Because I got $40,000 cash. What can I do with that? I can go down there to the funeral home and do a paid up funeral home policy, or paid up, not policy, but just pay up my funeral for me and my wife and take care of all that. And there's really no need to have that extra whole life policy. So if that's what their mindset is, then say, why don't we do a cashback option? At the end of the term, you get all your money back, and now you got the same thing as the whole life policy. But guess what? You'll never have to pay for it again. You just get it's basically having a paid up policy, and you can put that in the bank. You can put it into annuity. You can do whatever you want with that 50,000. For me, I'd probably take that 50,000, forget going paying up the bill. I'd put it into a annuity and let that thing be building interest. So that's what I would do. If that's what their mindset is, I will probably not do one of these. I'll go back and convince them that it makes more sense to get all your money back and get your money back than drop it to an annuity or an IUL or something else at that point, and do that. So, payment protector, you guys have heard us talking about when you're doing mortgage protection, a decreasing term policy. That's what the payment protector is. I've only sold one of them in my 9 years. Of selling this. I don't sell them a decreasing term because they're too easy to somebody come in and convince them it's not a good policy, right? What happens is you pay a set amount. So instead of a $300 a month on a cashback option term or a 150 on a term, I might be paying 105 or 110 on this one, and it's for 30 years. But what happened is after 20 years, I'm instead of having 200,000, I probably only got about 50,000 left, right? So if something happened during that time, I'm not going to have that full amount. Well, people say, well, you don't need as much because you don't owe as much on your house. Well, true, but maybe I don't. But guess what? My wife and family could still use that 150,000 for just a few, not much more money. I can be fully covered for the full length of it, right? So that's what I want to consider. I don't know that I want that decreasing term to where at the end they don't have anything left. And they're just trying to save money. There's better ways to save money, but once in a while they're going to say that's what I want, and if that's what they want, we do have options to do it. And then you got your accidental death. If you just want to do an accidental death policy, you can do it right here as well. Okay. So then let's get out of this one. Let's go to the IUL one. And I'm going to tell you what I like about this and what I don't like. Okay. Stay with that 40-year-old. Okay, instant decision, IUL. I like the word instant decision, okay? Because sometimes I'm going to give you an example. I had a guy that told me, he said, I'm in perfect health, Darren. I'm like, oh, are you? And he's like, yeah, I take maybe a couple of little meds. And so I wrote him a North American term, but they did the fully underwritten, meaning they sent blood work and had him pee in a cup and did all that. Sent it into labs. After about probably 4 to 5 weeks, I get an email and it said he was declined for insurance because his prostate levels were high, elevated. Well, I called him. He went to the doctor and got it checked out and got some medication for it. But the fact is, he got declined with insurance. Now, because he got declined, he's probably not going to get an Americo or anybody else because he's been declined for a term policy. Sometimes you don't want to do a fully underwritten because you can screw them out. It's always better to try to get them an instant decision if you can. But the problem is they're going to be higher than the other one. So when would you use an instant decision and you think they qualify for a fully underwritten? What I'm going to do is I'm going to say, here's what I'd like to do. And I'm going to give them that example of my client. His name is Clark. I'm going to say, look, I had a client named Clark. It's the situation. He thought he's in great health. He sent the blood work in, came back, and they declined him. Now he's declined. We can't get him anything. I said, knowing what I know now, I think I would rather go ahead and get you started with the instant decision, and let's get you something on the books. And then we can go ahead and submit the paperwork and go ahead and submit for a fully underwritten. And if you get approved, it's going to be a better deal than this one. You're going to be cheaper and it'd be great, right? But if some reason they find something, you've already got insurance. So then I can do it. So then I'm going to write this policy up and then I can go back and do the other one. And I hope that makes sense. Okay, but let's show you what I like about these. So, okay, on this one, let's say I want to do, let's say I want to do 200,000 face amount. Okay, monthly bank draft. Okay, we're going to do the S&P 500. So this is their go-to. Now, the other ones, remember, if you're doing a fully underwritten or doing another type of term, maybe through National Life or I mean IUL through F&G, they're going to let you decide how you want that because of their easy, simplified issue. They're going to put the money in the S&P 500, and we're going to go 100%. They can break it down, but we just leave it just like it is. Okay. You can do additional funds, but we'll just leave it here. If you wanted to add money to it here, that's where you would do that. But we're just going to see what 200,000, make it real simple. For him to have $200,000 of coverage, it's $126.87 a month. All right. But here's the easy part. This is what I like about it. Create report. And then I'm going to open report. Now look at that quick. I have an illustration. And when I do an IUL illustration, I typically run right down here to about page 8 or 9. And I'm going to look at the non-guaranteed and I'm going to show you why. It's showing right now about an 8.45. And when I look at the 20-year average of what the rates have been, I think it shows here, it's about 8 non-guaranteed on this one. Let's see. Here it is. 9.53 is maximum coverage, but so these rates over 20 years, you got 2005 to 2024, you can kind of see where they've been, right? In the 15s, really, really good performing here. And as Scott tells you, usually you'll have about 2 good years, and then you have a down year, and that's kind of consistent. You can see that in that illustration. But what happens when you have a down year? Almost every time, it shoots way up the following year, doesn't it? So this is a great way to kind of just look at that. But over the 3-year period of time, or a 20-year period of time, I'm pretty confident to say that we can look at that 8.45 and know that we're going to be giving them some pretty good estimates on this. And that's why I do the non-guaranteed. And I look at this. So on this one here, they're going to have $200,000 worth of insurance. And at the end of, so this one, when they are 50 years old, so we did a 40, they're going to have about $7,600 in cash value. Say, and when they're 55, they'll have about 15. So when they're 60, they're going to have about 26,000 in cash value, about 200,000 still in insurance. So the difference in this one and the other ones, the way we build out on National Life or with F&G, is that we're going to structure those, right, to where you can actually build that cash value a lot stronger. We're going to be putting more money into it. These are just a very simple way. If somebody wanted a very simplified issue, um, just wanted to know, hey, if I did this. Now, if we look at the comparisons to this and that cashback option, it's actually cheaper than that cashback option. And if we did a 30-year on that cashback option, we weren't going to get 53,000 back on it. Look what happened on this. This is why, knowing what I know today, I will never write another cashback option policy. I will do an IUL with them. It's the very same underwriting. But look what happened after 30 years. I'm going to have about $53,000, even on a policy like Americo. I'm going to have a $53,000 worth of cash value, but I'm still going to have my $200,000 in insurance. On the cashback option, how much insurance do you have at the end of your 30 years? Zero. On an IUL, you're going to have $200,000 worth of insurance, plus you get about $50,000 that you can play with, right? So knowing what I know today, I will probably not write any more CBOs because I didn't know about IULs back then. Nobody pushed them back when I was doing mortgage protection. And I sold a lot of cashback option. Had I known what I do today, I wouldn't have done that. So I'm going to stop share and make the screen bigger. And we're just going to talk about what I talked about today, okay? So questions from you guys. What are some thoughts and questions you guys might have about America?
I was gonna point out something that I don't think that you did that might be helpful.
Yep.
So when you're looking at, I don't know if you want to pull it up, but when you're looking at a whole life policy for somebody with a Eagle, you know how, because it has the 3 different tiers. So it has like the preferred, standard, and modified or whatever. So if you want to know what those numbers are, you click create report and then it'll show you all of them. But I didn't know that at first. So I just thought a new person it might be helpful for them.
It would. So Jody, they didn't used to have that option when they just added that new Eagle series. It's called Eagle Plus, and it used to be Eagle, and they had 2 options, right? You had regular Eagle, or you get guaranteed. But now they've actually got the 3 different series. So if you went to create report, they're actually going to give you all 3 of them, and the guaranteed. Now, the guaranteed is always going to be higher with Americo. I never write a guaranteed issue Americo, unless they're just wanting multiple, right? If they say, well, I want, because maybe they currently have dementia, right? Or they got, currently have dementia, they got current cancer. You're not going to get anything but a guaranteed issue. You could get them in Americo, but I'm probably going to write them a AIG or I love the InstaBrain guaranteed issue. The rate's going to be cheaper, but sometimes I think it was Gail the other day that had this question, or Sherry, about a guaranteed issue, and I think it was Gail, and I said, ask the client, because sometimes they want as much coverage they can get. Because here's the deal: if you know that you've got dementia, it's a death sentence. There's no cure for it. I mean, it's going to be a death sentence. If you got Alzheimer's, it's a death sentence. Typically, it can be 3 to 4 years, but at some point, you're going to pass away from it. If you've got those. So, in those cases, when you get those, sometimes they're going to say, "Well, how much insurance can I get?" Well, you can get 25,000 through this company, and this company will give you 20, and this company will give you 25, and this company. And they're going to pay because it's going to be guaranteed payout after 2 years. And if you're early onset of that, a lot of times you live longer than 2 years. But if not, you're still going to get all your money back you paid in plus 10%. Is that a bad thing? Not a bad thing, right? Because where can you put your money in a bank and get 10% back on your money you put in? So guaranteed issue, don't be afraid to write them if they've got those issues. Matter of fact, a lot of times when you show the value of it, you can sell 3 or 4 guaranteed issue products. Okay. Anybody else? What's your thoughts on America? You guys like it? I definitely like it for two things. I like it for the whole life, final expense. Americo Eagle will probably be my go. You guys will see me when I'm selling. You're going to be selling. That's what I'm probably going to go to. You won't see me writing any more Aflacs now that I've got this carrier in place. This is where my go-to is going to be. Baltimore Life is still good, and there's time you can write Baltimore Life and get them. Um, I like the COPD option at Baltimore Life, where these guys are probably going to get you a standard rating. You're going to get a preferred rating with those guys on a lot of occasions. So there's times you want to use another carrier, but ultimately, Americo and Baltimore Life are probably my two favorite, knowing what I know today. Um, now that's on that. Term policies, it's good for the underwriting and simplified issue, get it done very quickly, but ladder is not bad. But we did have somebody get declined with ladder this week. I had two people get declined with them. So they do a pretty deep dig on it. Ladder looks at they do look at credit scores. They don't pull it's a soft credit, but they do kind of look at that. And sometimes they'll decline it for that. They do a pretty deep dive into I think it's called next something, the one they use for their MIB reports. I can't remember the name of it, but it was something I'm kind of not familiar with, and I had to dig into it a little bit. And they really do a pretty good check to make sure you're not lying about your height and your weight and stuff like that. So they're going to look pretty close on it. So I did have two declines with Ladder this week that I that's the first time I had any declines with them. So knowing that, I would have went Americo on that one, but you don't know. Sometimes you just don't know what you're going to get. So you got to try the other ones um, in those cases. So, but term policies, I like the instant decision IUL. If you're looking for something simple, quick, and they're just wanting an IUL, and you can run them illustration, there you go. If it's something that we want to do, really, we're building with Scott, within the advanced market, Scott's probably going to say, let's go ahead and do a National Life or a FNG or one of those. But there's times, as I mentioned, that you want to do an instant decision just because you never know what's going to show up on the blood work. So it's not a bad idea to have that in your back pocket for sure. Does that make sense with anybody? And what's your thoughts on the cashback options and the IULs and all that stuff? Let's hear from you guys. Nobody?
I definitely like the IUL over the cashback option, especially with Americo. I was just running a side-by-side comparison. It's a little bit more money to get the IUL than a regular Term 100, but you get the cash. I mean, it's way cheaper than doing a cashback option to do the IUL. So I think that's a great option.
It is. It's going to be cheaper than the cashback option. Plus, you got insurance at the end of it. I won't ever write another cashback option because the underwriting is exactly the same as the IUL. So why would I do that to them? I can put them in an IUL and show them that value. Now, the only time I wouldn't do that is if the client said, no, somebody wrote me an IUL one time before. I hated it. I ran out of money. They didn't structure it right, and they don't trust them. And then I can say, well, let's just do the cashback option because it's guaranteed. You know what you're going to get back on it. And there's a time to pivot, but you got to know when those times are, right? Anybody else? Good comments. So, yep.
So the IUL is not guaranteed versus the cashback is.
So an IUL, a cashback, you know what you're getting back as long as you pay on it, right? As
Okay.
long as you pay on your policy, you're going to get your money back. An IUL, the only guarantee you have on an IUL is that you'll never lose money on an IUL. Like if we went on a 20-year broke as a skunk country, where the country is not making money and the stock market crashes for 20 years. But you guys saw the 20 years. I broke down and showed you what it did over the last 20 years. That's never going to happen. Okay. And I'm not going to get political, but I'll just tell you it's not going to happen. over 20 years, you're going to make some money on that. And the chances of it is you're going to make probably in that anywhere from 7 to 9% range. You're going to get back, which will always be better than the cashback option. Who makes the money on a cashback option when you invest in? So let's say a term 100 is $100. A cashback option is 180. What does that mean? That means I'm taking $80 more a month. And who's making money on that $80 a month over the next 20 to 30 years? Are you making anything on it, Leanne? Are you going to make anything on that $80 a month over 20 or 30 years? Zero. Who's making money over on that money? The carrier, Americo. So Americo will take your $80 and they're going to invest it over 20 or 30 years. They don't mind giving you all your money back because you gave them $80 a month for 30 years and they invested that money. Compound interest and multiple times, right? Wouldn't it be better for you put that $80 a month into an IUL and you get the money, you get control of the money on an IUL? That's why a cashback option don't make any more sense to me. So where did that come into play for you guys? If you're doing mortgage protection and I call somebody up and they said, yeah, I've got a policy already, I'm going to ask them, is that kind of policy that gets your money back at the end of it? And if they say yes, which probably 70% of the time they're going to say yes, because that's what we were told to sell, I say that, so is return of premium or is it an IUL? And they're going to say most of the time, no, it's the one where you get all my money back at the end of it. Now I'm going to say this question. I'm going to say, so at the end of it, how much insurance do you have? And they're going to say, well, none because my insurance ran out. I said, well, why don't we look at an IUL where I can get you that same amount of money back, but you're going to have insurance at $200,000 for the rest of your life. And they're going to be, interested, right? And how do we find those? You buy that mortgage protection leads through LeadCo and buy the tier 2 or tier 3 because these people have probably already been sold a policy, or if they hadn't been sold, then you could sell them one. And now we got a whole new product that had never been pushed on mortgage protection before, right? Because they didn't do that until recently. But now it makes a lot of sense. Right? Kenneth, Kenny, what's your thoughts on that? You've been doing some mortgage protection for a little bit.
Darren, I just wanted to share. Good morning, everyone. I
Teresa.
got some leads from LeadCo. I got them yesterday and I started making calls. I called
Got it.
about 10 numbers and I have an appointment set up for today.
Beautiful. Good job. Nice. How many leads did you start off with buying?
115, I think it was.
Nice. What did you buy, tier 2 or tier 3?
Tier 2.
Tier 2, my favorites. I like the tier 2. It's not so old, but they're not, they're right where you want them because on those, if they haven't bought a policy yet, then they can be sold a policy. If they've already been sold a policy, nobody can beat our carriers. You look at things like ladder insurance, where we know we're going to double the amount of coverage they got for they're paying. And then if they bought a cashback option, I'm going to show them an IUL. And so I've got those carriers that, like, I will buy those LeadCo leads in a heartbeat for those reasons that we can either sell them. We got products at our fingertips that nobody else really has that we can beat the heck out of them. If you were working for the other company that I used to work with and that Teresa and Misha and them worked with, and Helen, they didn't have these carrier options that we have today. And they were being kind of told how to sell those. Now we got a lot more options that we can go with. Good job, Teresa. Anybody else? Questions? Okay. If you don't have Americo, reach out to Jane and say, Jane, please send me the Americo contract. I would like to have that. All right. And let's get started using them. I want to pivot to them more than I would do the other carriers. If we can, let's start writing a little bit more of those. And another thing is it's a quality company. So we got that contract with Quilty. So where did that come into play? If you were looking up quotes in the Navigator and you had Americo and Mutual of Omaha, those will start showing up in the Navigator to where those quoting prices will come in, and you can pull and then you can go to apply. So you can set that up in your Navigator to where it will be one of your carriers off of that. Okay. Anybody else? All right. Well, guys, get ready. We got our training in the morning at 9 o'clock. Anybody that's doing health, LifeX, and it's just going to be me, you, and Jane, us and Jane, and we're going to be going over our leads tomorrow. So if you're going to be doing any life leads, I want you on that 9 o'clock training. We're still going to do a Friday at 2 with Rick. It might be our last one we do with him in the evenings. I don't know. Um, I think at some point we can figure this out on our own. But we're going to do one more this Friday at 2 o'clock, 2 or 3. I'll find out the time for sure. And then meantime, tomorrow at noon, we want to see you on the AMM training. Real excited about that. Boot camp coming up. If you hadn't signed up for boot camp, I think we got a few spots left. That's in Sarasota, Florida, on May 12th, 13th, and 14th. Make sure you get signed up for that. I think Leanne might be able to, if you can post that in the group me for us, just so they can have a refresher if you want to do that. Other than that, love you guys. I'm here if you need me. I'll be hanging out in Coach White's office today. And you guys come see me, talk to me, okay? Y'all get to work. We'll see you.